What's going on, guys? It is the Zoomer Value Investor here to talk to you guys today about a video I'm really excited to bring to you guys. I think this is going to be one of the most important videos I've done, because I'm going to be talking about a really important component of the American economy and a really important component of my portfolios, and probably what's going to be in my portfolio for like the next 5 years going forward. Of course, as you can tell by the title, I am going to be talking today about American Big Tech, also known as FAANGS. I've also heard called manga before, with like the Facebook change to Meta. But of course, let me break down this FAANGS acronym, of course, with the 2A on FAANGS. F, we got Facebook or Meta, Mark Zuckerberg's big conglomerate giant, social media giant. You got A, Apple, of course, the biggest company in the world, a huge cell phone market. The second A, Amazon, the biggest e-commerce company in the world and the biggest cloud computing company in the world. N, Netflix, this is the heftiest valuated streaming platform in the entire market right now. G, Google, this is the most popular search engine in the entire world. In S, this is actually Microsoft when you hear the FAANGS, because the ticker is MSFT, so the S is Microsoft, and this is a huge diversified revenue tech conglomerate. Why are these companies so often mentioned together? Why is the FAANGS acronym even a thing? What makes these companies so important, and why do I have so many of these as a percentile in my personal portfolio? And more off that, why have they been doing so well? And why did we just see huge earnings recently that shot up these stocks? Big gains for investors, especially if you've been in these stocks for the last like 10 years or so. Well, these companies in our new modern day and age, they have emerged as leaders in some type of field, some type of commercial technology that people tend to use. Of course, you know, Meta is a huge social media giant, Apple with a huge cell phone market, you know, Amazon with e-commerce, Netflix with streaming, Google with search, Microsoft with just literally everything. I mean, they have like Teams now and stuff, like they're doing Zoom's job. On top of that, you're talking about crazy cash flow. You're talking about companies that have been expanding margins throughout the years. They've been creating value for shareholders. Another thing you gotta keep in mind is tech is disinflationary by nature. So for example, if you're an investor, right, and you go, you know, that Apple company looks really interesting. I do enjoy like the Macintosh computer, stuff like that. I got $10,000 after working 40K at my job here in 2003 left over, so I'm put this $10,000 into the company Apple. Well, that company Apple, they went on, they had a lot of inventors, they had a lot of innovators, and they just did a lot of things. And one of the things they did do was, you know, something like the iPhone. You know, Apple, they just keep innovating, and then it just produces cash, and it produces cash, and it's just like, it creates tremendous value for the shareholders. So, you know, that person, I had another video about income does not equal wealth. That person who only, you know, made 30 to 40K, you know, all those years ago, they were 30, 40K year earner, because they made that decision to put 10,000 into Apple all those years ago, they're actually a tremendously wealthy person. You know, even if they were working like that post office job still to this day, or, you know, whatever it was they were doing to earn something of that nature that was, you know, that average US based salary, moderately estimated amount. So again, that's just something that's just way too attractive about these stocks. It's just by nature, the disinflationary state of technology that just you are buying into when you buy any one of these companies. And of course, you know, this offers innovation to investors. Now, I did mention innovation before, but innovation is becoming, it seems like in the modern day and age, more and more of a scarcity, because of just the fact that so many innovations are being done, and the innovations that are still left to do are, of course, at that next exponential point of difficulty. With that being said, buying any one of these companies, you're going to be buying into a company that has a team of pretty much the best innovators in the world at that time. If not, it's possible they just hire some of the best innovators to work for their company at a comfortable technology job with tons of, you know, free food and, you know, good pay, good benefits, everything, that thereby making that other person, you know, who would have created perhaps the next like Google search engine, that would have maybe been better than Google, would have like been better at being better formingly fit to the user than Google could possibly be, then that person, if they ended up getting hired by Google for like a 200, 300K a year job, tons of like free food. If you haven't seen the Google campus, a lot of those people, they get like good massages, they get like areas to work out, little comfortable places to work in, tons of outdoor space. Like, of course, like, and that's great, right? Anyone wants to be like comfortable at the job. I'm just making the point that sometimes these people, they work their 9 to 5 at a place like Google, and they become very comfortable, and they often drop personal passion projects that they might have had. I also want to mention that these companies do put in an employment contract that you are not supposed to be building on any kind of thing that can be a competing technology while you are an employee of them. So it oftentimes pigeonholes these people who have incredible tech knowledge at a place like Google to then go and just explore other endeavors of their life that are outside of like the tech world, even though they are incredibly gifted and studied in tech. It's because of these like kind of like subtle competing clauses in the contracts with a lot of these big tech companies. So that's one of the things you are buying into. You are buying into basically a sink of innovation, right? That is almost like capitalism. It has simply just won like this market, where an incredible amount of the innovation that does come out of the United States at this time does come through something like these 5-6 companies that I'm talking about here today in this video. And that brings me to my last point of my first few points here. That is, after mentioning all that power that these companies have in my last point, I'm going to talk about how they have even more power with how they shift governments. That's another definitive factor when you talk about things like American big tech. They truly do shift governments. How is this done? Well, in the United States, we do have one of the most capitalist, free market type societies. It's not laissez-faire capitalism, however, it's capitalism with some subtle regulations and a lot of rights to trials. With those rights to trials being, of course, in Constitution and things of that nature. That means that a lot of these big tech companies, they have just squadrons of lawyers that are, well educated, well studied, also well versed and articulate in things like debate and going to court. And they're able to swing a lot of loopholes and a lot of arguments and a lot of decisions in the court in favor of these big tech companies. Obviously, the U.S. does have some like antitrust laws. There's things like the Sherman Act, I think around like 1890, 1900. And then you have like the FTC, I think came around maybe around like the 1910s, 1920s, perhaps. President Roosevelt came in with the New Deal shortly thereafter, kind of try to also moderate antitrust while also moderating like the good aspects of capitalism and letting businesses run as businesses do. So I'm making the point that yes, the US does have that state of like antitrust and coming up like from the roots of the last 100 years, 200 years to show capitalism with trying to build some antitrust. But these companies, these big tech companies are so good at, once again, getting proper lawyers, finding legal loopholes, and being finicky, although they do deal things with like shifting the culture, perhaps the company kind of like trying to like swing narratives a certain way, or not only just the company's narratives or agendas, but also just when you consider the immense amount of users that these companies have, as well as the amount of user data. It gets to the point where these companies can change society so fast, like under the government's feet, without the government really being able to do anything, because of all the legal loopholes and all the legal battles that both sides essentially have to fight before any like movement can be made. The United States is so much of a checks and balances system that it really means that these companies, it looks like these companies are just going to continue just printing cash and just dominating businesses and just stamping out any potential competitors that could rise through the that could rise just through as time goes on. But it just seems like these companies tend to buy them out or, you know, hire them before they start getting deep into their business endeavors or whatever it may be, right? So these companies truly do shift culture and they shift governments. Now that's something I really want you to keep in mind. So let's talk about what value I have found here in the big tech markets and why they've been doing pretty well and why I've been overall very, very happy with my investment in these companies. Let's talk first about Meta. In the YouTube portfolio at a cost basis around $110, $115 per share on Meta Tech. As you can see, that investment's done really well. It was hanging out around the 200 range. I was selling off just a little bit of it. And as you can see, that investment's done really well. Huge announcements to drive that stock price, drive the alpha to the upside. Things like you heard like that $60 billion buyback that Zuckerberg announced. As well as we had that phenomenal earnings report. Last earnings just blew everybody out of the water. You saw looking at good user growth still, even on these social media platforms. These social media platforms seem to have still strong user adaptation, looking at like 5% year over year, just as far as like generating users, like not even talking about the margin expansions that Meta's seen to the upside and their ability to like monetize new platforms like IG Reels. So, you know, essentially I was buying this company. I remember the lows were around like $88 per share. And I even bought like around there and came out to a cost basis around like $110, right? You know, didn't buy the perfect bottom, but got as good as we could, of course, right? And lo and behold, I always kept mentally in my mind, this is like a $200, $300 stock, you know, despite whatever price changes happen. And there's a lot of negative sentiment about their metaverse investments that are way, way, way future looking, maybe into 2030. Despite it all, I just kept looking at the balance sheet, kept looking at what I value the company at, kept looking at potential future cash flows, and bought the stock despite the negative price swings. And that's the thing, that's a lot of the psychology of money coming into it. And it came out to a situation where we're doing really well on Meta and a very comfortable position. I'm of course not comfortable adding to it generally at this price because generally I think it's around a fair price company at these prices personally. I do potentially see it running to around a $300, $400 stock, especially around 2025, 2026. So I plan to hold a decent amount of this in my portfolio. You know, there is a saying, let your winners run, and I do think about Meta that way. Next one I own is Google. This is a company where a lot of their revenues do come from search. However, they are starting on things like Google Cloud and things of that nature that are starting to finally diversify up their revenues in a lot more of a healthy manner. There was a lot of fear, uncertainty, and doubt with the Google Bard AI announcement, and ChatGPT has of course been doing very well. That is a thing from OpenAI that was recently purchased by Microsoft for around $10 to $15 billion. And when the Bard AI announcement came on, it made a little error about astronomy that some NASA experts corrected over Twitter, caused a little bit of panic about AI and the AI wars. Of course, a lot of articles coming out, fear, uncertainty, doubt fluctuated, 5-10% drop in Google. And then there was like the earnings in November of 2022, right? So Google was around like an $80 stock in November 2022. And then of course the recent Bard fear, uncertainty, doubt, the Google Bard AI, the doubt regarding that with the astronomy error in early 2023 sent it around like a $90 share price, but now we're sitting on Google around like, you know, $110 per share, $105 per share. And after a strong earnings where it beat on like revenues, and Google is just a company that simply prints cash and it simply just dominates the internet search algorithms. People just do not want to use things that is not Google Chrome. People just do not want to watch videos that are not YouTube. People just do not want to use search that is not Google search. They just hate things like Yahoo. They hate Bing. But essentially with Google, it was like, you know, I look at it as a great value, especially with like an $80, $90 per share, buying into the company, big tech, a leader, less than a price to earnings of 20. I was buying it at like a price to earnings of like 17, maybe it's like 16. You know, just given it's in that like field of tech where it's of course, you know, building things like the Google Cloud that's going to like produce a lot more cash, and just the fact that Google just in and of itself produces tons of cash, it's very low debt. To me, it was a pretty like no-brainer that I probably would get something like a 50 to 100% gain of this over like the next like 2 to 3 years. The last company I want to talk about is Amazon. Now, Amazon is a company where a lot of value investors look at it and they go like, no way, this makes no sense. But Amazon's not a traditional company because the Jeff Bezos method is very, very different. I've pointed this out in a previous video, but I'll give you this gestalt analysis. So Jeff Bezos is a person who hates paying tax, right? So when his company produces cash, his company Amazon produces cash, he oftentimes likes to reinvest that into things that Amazon goes and does to the future. So, one of those reinvestments was Amazon Warehouse Services. Now, Amazon Warehouse Services is now the biggest cloud player in the world. You often hear AWS. That's like now the biggest platform that cloud's built on in the entire world. That came from like a Jeff Bezos reinvestment because Jeff Bezos produced cash, didn't want to declare that cash as earnings, and he reinvested it back into his business of Amazon. So when you actually consider capital expenditures for Amazon, and their capital expenditures were around the range of 60 to 70 billion, as well as the decent earn. So you look at capital expenditures at Amazon, and you consider they had a capital expenditure of something like 60 to 70 billion. The price of earnings that looks like it's very, very lucrative for Amazon, like it's 80 or 90. It really should be something like 12 to 15 price earnings business. So let's talk about Apple. Why is Apple not in my portfolio? Well, essentially, when you look at Apple at a stock from a value investor perspective, which is typically the price of the stock relative to the underlying earnings of the company, it comes out a little bit hefty. And normally at an eyes glance, one way you look at this is the price to earnings. And you look at Apple, has a price to earnings kind of hanging around in the high 20s, like 26 to 29. And at that price, I don't really particularly find it attractive if Apple came down to a price around like 120 or better yet 100. 120 I believe puts it around the 20 range, and then 100 obviously will be well sub 20. So I think Apple becomes incredibly attractive around those ranges. Of course, these are, price changes in the stock with no fundamental news changes in the company, no story changes about the company of Apple. In a situation like that, in $100 to $120 share price of Apple, that's kind of where I'd start to build my position. And yeah, I for sure would consider Apple a core holding in my portfolio. Honestly, it has to do with just these guys right here. It's just like everyone has one of these, and it's one of the stickiest revenues ever. And then you consider things like iCloud and all the accessories with AirPods. I mean, absolutely just prints cash. It's one of those things where it's once people get some Apple products, they can't really stay away, and then they're just kind of customers for life in a weird way. Netflix. Why do we not own Netflix? Well, Netflix, I've always kind of colloquially called it Netflix, just kind of out of fun. I actually think after some price changes and some changes about the business and the balance sheet and stuff, it's actually not too bad of a business to own nowadays. However, I just kind of have stayed away from it. I believe there's some better value in the streaming industry, not so much from a straightforward price to earnings perspective, but just out of looking at cash flow and investing based out of cash flow. I think that I'm more interested in a stock like Paramount or Warner Brothers Discovery than I am so much in Netflix. I believe I just could double my money faster than these other streaming companies. The other thing I don't hear talked about Netflix enough is just they have to pay so much for their content. So for example, Netflix, take a Netflix original film such as Tall Girl 2, for example. This is a film where they shelled out $20 million to produce a film like this. $20 million, and then, obviously the audience is going to wash that up, and then they're going to want the next thing. Not everyone at Netflix who has a Netflix subscription is going to even be into those kinds of movies. You run into a situation where it's Netflix is just continually paying a sunk cost to produce content, literally just to keep their business afloat. And you look at a company like Paramount, a company like Warner Brothers Discovery, where it's they just own so much IP, intellectual property as is, with just all the different franchises and stuff that are under those those media conglomerates names. It's the extent where they just don't have that to sweat that as much as it is Netflix has to sweat that. And I think a lot of the innovation that Netflix has provided as a streamer has kind of come and gone. I think it kind of will be a household name still with the originals, the Netflix originals, stuff like that. So But do I think it's going to be like a lucrative gainer still? Do I think it's going to keep pace with the gains that I think like something like Google, Meta, or Amazon's going to have for the next 5 to 10 years? I do not. I do not. And because of that, I do not own Netflix at this time. Microsoft, finally, why do we not own Microsoft in our portfolio? It's the same issue with Apple. I think it's a fundamentally great company. I should really love Microsoft. I would personally love to make Microsoft my biggest holding in my portfolio. But of course, I would like to do it at the right price. So I would like to build my position at a price where Microsoft's not so fundamentally expensive relative to their underlying earnings. I do not want to be paying that premium if I do not have to. If I can catch the market, Mr. Market, at a time where it can sell me the stock at a cheaper price, that's when I would like to jump on it. So Microsoft, it's currently hovering, around $260 per share, but I would like to buy it closer to $220 per share, or better yet, $200 per share. And that's for like starting to build my position. And of course, I would get more and more aggressive with wanting to put cash there, just as however lower the price may go from there. I hope this video helped you. I hope this video was useful. Please leave a comment, please leave a like, comment anything that's on your mind as far as the markets. I appreciate your likes and your comments for the YouTube algorithm and the YouTube overlords.